Stream on the FOMC rate decision, and let's just start off with what the FOMC did. They didn't do anything. So yet again, pretty much in line with what the markets were expecting, and we'll look at the FOMC forecasts based on market expectations in a moment. But I think what was really interesting this time around is what the Fed commentary was around uncertainty. Because, of course, what we're seeing at the moment is huge uncertainty around trade policy, uncertainty around geopolitics, and, of course, from the Fed's point of view, it's really uncertainty around macroeconomics, because what they have to do is steer the ship based on where it'll be in the future, and any changes they make today will operate with a lag. That's the fundamental problem of central banking. So when the forecasts become more uncertain, it just makes the Fed's job that much more difficult. So a lot of the commentary today was about how to deal with that uncertainty, how to cope with it, and also pretty much what the Fed expects now, and why they've downgraded their growth forecast, increased their inflation forecast, and its overall impact on their policy going forward. So that's what we're going to talk about. And we will talk for about 20 minutes. I'll just summarize what the Fed did and why, and where the state of the US economy is based on what the Fed said. I'll talk briefly about some of the questions in the press conference, because that's the really interesting part. And then I'll throw it open to you for questions, and then we'll end. That's the plan. And please do like and subscribe. Otherwise I'll get in trouble with Laura if I don't say that. So let's begin. I think the thing to remember, one thing to remember, is that Powell's term is coming to an end. So always good to show this. So in May 15th, on May 15th, he's no longer going to be the Fed chair. There'll be a new one appointed by Trump. So it'll be interesting to see who that is. But he's going to be here for a while. Now, this was the actual statement that came out today. They come up with this statement a half hour before the press conference, and the changes are shown in red. This is based on Nick Timraus of the Wall Street Journal. He publishes this every Fed meeting, and the red parts are the changes. Now, the important parts here, notice that usually they talk about risks to the upside for inflation and the risk of rising unemployment, and whether those two are balanced. But you can see here that that language has been retired, and instead they're talking about uncertainty around economic outlook has increased. So it's all about uncertainty now, waiting for this uncertainty from trade policy to feed through into the economy, to see what effect it's going to have on growth and inflation. Well, unemployment and inflation, because those are the Fed's dual mandate. This section's also interesting. They're talking about the slowdown of the rate of quantitative tightening. So the way this works is a certain number of treasuries are allowed to roll off, mature, but the cap on that is being reduced from 25 billion to 5 billion. So the rate of shrinkage of the balance sheet will slow down. Now, the reason for that is that, remember, when we had a problem with liquidity in the past, the reserves weren't ample enough. That was the problem, and there were problems in the repo market which caused all sorts of problems in the economy, and that caused a little bit of an issue for the bond market, certainly, and that spilled over into the equity market. Well, what they're doing now is they're being more careful, just to ensure that there are enough reserves to keep the financial system ticking over. The MBS, the rate of MBS redemptions isn't being changed, so that's going to carry on at 35 billion a month. And then finally, there was one dissenter for this Fed meeting, which is unusual for the Fed. Monetary Policy Committee in the UK often get dissenters, but in the US, usually they vote with the Fed chair. But Christopher Waller supported the halt in the Fed funds rate, keeping it where it is, but he didn't agree with continuing the current pace of decline. But he preferred to keep the current pace of decline of treasuries. So that was interesting that there was someone who dissented, unusual. So now let's turn to the insight into what the Fed's thinking is, which is the summary of economic projections. So it's not a forecast, they always say that. And what it is every Fed FOMC voting member gets to put one dot onto these forecasts. And each dot is one forecast, so they call it the dot plot. Here you see it in a summary, in a table, which I think is easier to understand. At least I'll show you the dots in a sec. But you can see here the big change, I think, is the change in the GDP projection. Now, I don't know whether you're aware, but Goldman Sachs recently cut its GDP forecast for the US by 0.5 percentage point. Roughly, in fact, it's roughly the same as the change that the FOMC's come up with. So for 2025, it's reduced it by 0.4 percentage points, from 2.1% growth to 1.7%. And that's because of trade tariffs. 2026, slightly smaller cut, 0.2 percentage points, and then in 2027, hardly any change, right? So it's like a 2025 front-loaded negative impact on growth. At least that's the feeling so far. And remember, we're only 9 weeks into into the Trump presidency at this point. So we're not really going to see a lot of that uncertainty feed through to the hard numbers yet. But this is a forecast. And then for inflation, remember that tariffs tend to be inflationary. So they've increased their forecast for inflation by 0.3 percentage points for 2025, and then 26 and 27 are the same. What effect does that have on policy? Well, none whatsoever. Okay, so the federal funds rate projection, exactly the same. And then Powell in the questions, a couple of the journalists asked, well, why have you say inflation's going to be higher, why are you still doing 2 rate cuts? You haven't changed that at all. And he said, well, the two balance each other. If you've got lower growth and higher inflation, they kind of balance each other, he said. So that's the logic behind it. But overall, no change in policy. So if we look at the policy forecast, the red is this latest forecast in March. Black is where it was in December. And you can see that there's no change at all. So he's still expecting 2 rate cuts in 2025 and 2 in 2026. So that's the overall effect. It doesn't affect policy, but lower growth, higher inflation is what they're expecting in 2025. So now let's go to what the markets were expecting. And this is kind of interesting because it's changed so much. So September 2024, this is what was expected. Just a slew of cuts, 50 basis points, 0.25 percentage points, 50 basis points. And every meeting they were forecasting another cut. Then we went to, well, actually, no, we're going to cut much more slowly than previously we expected. By December, just 3 rate cuts. And then once Trump won the election, suddenly there was consideration of hikes because a lot of his policies are inflationary. Now that's kind of abated somewhat. We've only got a very slight probability of hikes in 2026. And we're back to 2 rate cuts in 2025, and then maybe 1 in 2026, maybe 2. The second one is towards September, towards the end of 2026. So that's what markets were expecting. And of course, for today, there was a 99% chance that the Fed would do nothing, and that's exactly what they did. So almost always the Fed does what markets expect, and today was no exception. Now, if we do look at that Fed balance sheet, you can see the effect of quantitative tightening. And really, the size of the Fed's balance sheet has not shrunk by that much at all. It peaked at about 9 trillion. Currently, it's at about 7 and what is that? Just under 7, maybe 6.75 trillion. And already the Fed is starting to slow down that balance sheet contraction, which is kind of interesting. We're way above where we were even in 2015. And, you know, in another universe compared to where we were in 2005 before the global financial crisis. Now, what was kind of interesting, let me show you this, because I think this is interesting. The conversation around the rate of balance sheet runoff, according to Powell, started when they were looking at this graph. Now think of this as like the checking account for the US government. So if they have a large amounts of money with the Fed, then this Treasury General account is flush. And you can see that at this point in 2024, actually let's zoom out. So after the pandemic, you can see that there was a huge amount of money in this Treasury General account, a very unusual amount. Then that fell dramatically as the spending programs cut in. And then what we saw was kind of a fluctuation down again. This is when we started to have problems with the repo market, I think, in 23. Now we're back up. And then if we zoom in again, you can see that the Treasury General account has fallen quite dramatically since the beginning of February. And that conversation about balance sheet runoff was to do with this fall in the Treasury General account, which I thought was interesting. Now back to this. So, yeah, I think already we're seeing their policy kind of adapt to changes based on what the Trump presidency is doing right now. And running down that TGA seems to have certainly helped the conversation about slowing the runoff on the balance sheet. Now let's take a look at the press conference and some of the stuff that they were saying, because I think that was also fascinating. Now, of course, there were questions from the journalists about uncertainty, about Trump, about tariffs. And the real question, I think, for the Fed now is how much inflation is going to come from tariffs, which is transitory. There's that wonderful word. And how much of it is more sticky, because the sticky inflation is what the Fed can address with policy. The transitory 1 year increase in prices is not something that they can affect directly. That's created by government policy. So I think that's the problem for the Fed. How do they distinguish between the two? And their policy is driven by that ability to distinguish between the two. But all that Powell said is we'll try to separate tariffs from non-tariff inflation. But he didn't really say how it would be done. But what his point was, which is also interesting, is that the effect of tariffs, the sticky effects, if they exist, is due to anchoring of expectations. It's a psychological thing, which is that if you see prices rising, you'd expect them to carry on rising, and your behavior will change such that it becomes a self-fulfilling prophecy. If you're a business that's raising its prices, you'll carry on raising prices. If you're demanding wage increases, you'll carry on demanding wage increases. So if inflation becomes unanchored, if people don't believe the Fed can keep inflation at 2%, then that's when problems begin. So if inflation becomes embedded after the tariff increases in inflation, and there are signs that people are really sensitive to inflation now after this huge spike that we had previously, then I think it's more likely that that's going to become entrenched. And that's obviously worrying the Fed. But that's really the key question. Every Fed meeting after this, we're going to have to see whether they think what proportion of this inflation increase, if it happens, is due to tariffs and is transitory, how much is due to anchoring of expectations and is sticky. And that's going to be very difficult to do. Another big question was, have you seen the new policies reflected in the data that you're looking at? Because Trump's only been president for 9 weeks. And the general answer was that the soft data, things like surveys, things like the stock market, those things have really fallen in terms of consumer confidence, in terms of risk appetite. And the PMI survey, the manufacturing survey, showed a lot of weakness and uncertainty in business spending. New orders have been reduced because people are uncertain about tariff impacts, for example. So I think Powell stressed that soft data have weakened, true, but they focus on hard data, which hasn't really softened at all yet. So if you look at GDP, it's still pretty good for Q4 of 2024. If you look at inflation, it hasn't really changed that much recently. And the payrolls numbers have weakened a bit. Unemployment's up a little bit, but they're just going to have to see if that continues. Yeah, there was a couple of journalists asked about that balancing thing, about lower growth and higher inflation, and whether the two balance one another. So the actual question to why have you got two rate cuts? You're expecting higher inflation. Why have you got two rate cuts? And there was this kind of balancing thing that lower growth, higher inflation balance each other out. So let me just read out what he said. Remember, we came into this at the December meeting. The median was two cuts. The median was, and you see, broadly speaking, weaker growth but higher inflation, and they kind of balance each other out. That's what he said. No big change in the forecast, and it's not meaningfully higher inflation. Yeah, so that was just what he said. And then he said, but the second factor, it's so highly uncertain. We're sitting here thinking, and we're in touch with businesses and households all over the country. We have an extraordinary network of contacts that come in through the reserve banks and put in the beige book, and also through contacts of the board, and we get all that. We do understand that sentiment has fallen off pretty sharply, but economic activity is not yet, and so we're watching carefully. So they can kind of see the problem about to happen, I think, but the only way they've kind of expressed that is through a reduction in their growth forecast and an increase in their inflation forecast. So it's pretty clear that they're expecting a weakening. But I guess Powell's point was that the economy's in a good place. Monetary policy is in a good place in terms of not being too restrictive now. And so they can afford to wait and see, and the cost of waiting and seeing is not high at all. So they can afford to be patient. So that's the point. The monetary policy now is only a little bit restrictive. That's the point. Yeah, and then ample reserves, soft data. Yeah, I think that's about it. So let me kind of summon my cockapoo, and then we'll turn it over to your questions now. And it is quite late for us because, at my age, I don't usually stay up this late. I've usually had my cocoa and gone to bed. So we will have some questions. And don't forget that we've got the live stream this week as well for the Bank of England. So Bank of England is this week as well. That's tomorrow. So we'll be doing all this tomorrow night as well. Ted, come on. Treats. Oh yeah. You're all right now. You looked a bit stoned earlier. You're all right, mate. Yeah, he's not having any trouble eating the treat. Right then, off you go. Back to Laura. Back to Laura. Good boy. Go on, go and get built on. Good lad. So do ask a question. Do like and subscribe. And if you do ask a super chat, I'll answer your question first. And if you're one of our subscribers on YouTube as well, we'll push your question to the front of the queue. Yeah. Let's see if we've got any super chats. Oh, and I should also mention Many Happy Returns podcast, which you can watch on YouTube.
Today's episode is powered by
the Hidden Bull Market. That's what it is. So let me just share that with you. If you haven't heard our Many Happy Returns podcast, do have a listen. It's all about... there he goes. Many Happy Returns podcast. So I do this with Michael Pugh. He's the kind of clever, beautiful one, and I'm the old one who's slightly cynical. And this was the topic for this week. So there's Michael. And we talked about the hidden bull market, the stocks defying the gloom. Because although we have seen a 10% sell-off in equity, global equity, a much larger sell-off in the US, so we've seen a 10% sell-off, a correction in the US stock market as well. The global index has been affected by sterling strengthening, which is always bad news if you're a global index investor, because it reduces the value of US stocks. But yeah, correction in the United States, correction in the UK, if you're a global index investor, which is a 10% fall. So what could you have bought which would have defied the gloom? That's what we were talking about. So booming defence stocks in Europe and so on, but also the reasons behind that. So do have a listen. And let's see if we've got any questions. I'm kind of hoping there aren't questions, because then I can go to bed. Right. What have we got? Brilliant channel. Thank you, James Bardsley. Post FOMC, should one invest general investment account money in low coupon short-term gilts to minimise income tax? Yep. Versus high coupon gilts, given possible Bank of England rate cuts to boost the UK economy. Yeah, I mean, the direction is downwards for UK rates, no question, from the Bank of England. And for the UK, the balance of risks is much more tilted, much more skewed towards a weakening of growth than it is in the United States, despite all of the tariff policy. You know, the US economy is still in very good shape, considering, certainly in terms of the hard data. So I would expect the Bank of England to be cutting, maybe not aggressively, cautiously, I'd say. And if they do that, that reduces SONIA, the Sterling Overnight Index average rate. That reduces money market interest rates and cash rates throughout the UK. And as a result, you probably want to lock in a rate with gilts if you possibly can. Let's see if I can find the gilt curve on PensionCraft. I can, because I know where it is. Here we go, trackers. So this is what you get as a member, a premium website member. So let's go to macroeconomic. And my colleague Patrick Hadot, he updates these every day. So let's zoom in a little bit. This is the UK yield curve right now. And this is as it was yesterday's close. So on the x-axis, you've got the maturity of the bonds. On the y-axis, you've got the yield to maturity. Think of that roughly as the return you get from investing in those bonds. And we've gone back to an upward sloping curve, which is the way it usually looks, except for the long end, which does dip a bit. But most of the investors in the PensionCraft community focus on these bonds that you can buy and hold to maturity, with maturities up to, say, 5 years. And they create bond ladders where they buy a bond, wait till it matures, and then they buy another bond, another 5-year bond, say, or a 3-year bond, depending on how long their ladder is. Now, you can see that the yields at the moment, 4.45 is where I think the current SONIA rate is. So with a money market fund, you'd earn this around here. And then with these gilts, you'd earn around 4.2%, which is less at the moment. However, if it's in a general investment account, like you say, then what you have to think about is the gross equivalent yield. So we can have a look at that as well. Now, I've recently added this to our gilt table for our members because people ask for it and I listen. So these are sorted by maturity. There are only about 64 UK gilts outstanding, and I've sorted these by maturity. This is the column I'm talking about, gross equivalent yield. Now, this is what a deposit at a bank, for example, or a money market fund would have to generate in terms of return to equal the net yield of this gilt. So you can see that for this gilt, which is a low coupon gilt, the coupon's only 0.5%. Most of the return on this gilt comes from capital gain, which is tax-free. So if you hold this puppy outside a general investment, outside a SIPP or an ISA, if you hold it in a general investment account where you have to pay income tax, the net yield, depending on your tax rate, will be a little bit less than that gross yield, which is 3.89. Because you pay income tax on the coupon, the net yield if you're a basic rate taxpayer will be 3.76. If you're an additional rate taxpayer, 3.61. Or, if you think about gross equivalent yield, which would be taxed at the whatever rate for income tax that you pay, let's say you're an additional rate taxpayer, well, you'd need a rate of 6.56 to get the same net yield as this bond, which would be 3.61, once you subtract the rate of inflation. So that's a very kind of long-winded way of saying that some of these are incredibly tax efficient, the ones with low coupon. So if we filter by 0.5% maximum coupon, all of these bonds have a high gross equivalent yield because they have a low coupon, they have most of their returns made up of capital gain, which is tax-free. So I think if you are going to lock in a rate, it's not a bad time. I think that's a fair point, and I'd agree with you. Now's not a bad time to do that. So we've got a super chat. Woohoo! Thank you, Philip C, for your super chat. And Philip C says, why do you prefer global funds over the S&P 500? Also, do you like individual stocks? Okay. Well, okay, so the S&P 500, a US index, I like to hold just one fund. So that's my core holding. 90% of my wealth, usually, is in one fund. And 10% is in my fund portfolio where I do all the crazy stuff and I try to beat the market. 90% of my portfolio, my wealth, is buying the market. And I do that with one global fund. And why don't I choose just one country? Well, I think that's not diversified. You know, the US is 65% of global markets, equity markets currently. But why would I completely ignore the remaining 35%? That's not diversified. And there are periods, such as this year, when the rest of the world outperforms the US. In fact, there have been whole decades where the rest of the world outperforms the US. We saw it during the energy crisis in the 70s. We saw it in the 2000s when we had the dot-com bubble. We saw it in the 1990s when the US underwent a fairly poor rate of return relative to the rest of the world. And countries like China really grew very rapidly in terms of their equity markets. So I think it's important to remember that the US only outperforms the rest of the world about 55% of the years since 1975. People forget that fact because we've just come off this huge set of returns for the United States during this zero interest rate policy period. But the real question, I guess, is whether that's going to change. I think the US will still be a dominant market. I think earnings growth in the US historically has been very strong. That'll continue. But I think the leadership of the Magnificent Seven has been called into question by DeepSeek, but also by some of these tariffs. And I think some of these companies will be exposed, negatively exposed to those tariffs. For example, Tesla wrote a letter recently saying they'd be exposed to the counter tariffs. They wrote a letter to the US government. So, yeah, I think that's why I don't like just choosing one country. I want to buy the whole world. I want full diversification, and I don't want to choose a particular region, a particular country, and I want to have a very simple portfolio. But, you know, to first order, the global market is the US, but I just prefer a bit of diversification. Do I like individual stocks? I certainly buy individual stocks for fun in my fund portfolio. So I've got a copper miner portfolio. The thesis there is that there'll be a big demand for copper. It's very difficult to increase production of copper as we move towards renewable energy globally. Maybe not in the US, but globally. So obviously that'll increase demand for copper, limited supply, price goes up. So that's my copper miner portfolio, which isn't doing particularly well. I've got a UK small cap portfolio, which is just 14 UK small caps. Again, not doing well at all because UK small caps are very unpopular. And I occasionally buy single stocks for fun, but there's certainly not a large proportion of my portfolios, just to learn about stuff and to keep engaged in markets, really. But all the questions that people ask me is usually about the fund portfolio, because it's kind of interesting to see what people do. So yeah, that's my take on it. Back to your questions. How are we doing for time? I think Laura's probably unconscious at this point. Roman the goat. I think that means greatest of all time. So I thank you, John. RC says, and as always, thanks for listening. That's my catchphrase, yeah. Is it worth buying European ETFs with the EU promoting their capital markets? This is Visual Ghoul. Yeah, I think it probably still is. I mean, I bought that was another set of stocks I bought, European defence stocks, and that's done incredibly well. You know, Rheinmetall was one of the ones I bought, and I thought I was late to the trade, but that's actually gone up quite a bit. You know, I'm quite happy with that. Just double check how much it's gone up. So let me just list these. So as part of our community, they kind of all talked about these European stocks, but they couldn't buy an ETF, so they created their own pie on Trading 212 and shared it with each other, and several of us bought that kind of basket of European defence stocks. And how are we doing with that? Oh, pretty good. Okay, so for example, since I bought it, Rheinmetall is up 48%, Thales is up 35%, and Hensoldt is up 51%. And then some of them aren't much up at all, like Airbus 0.39%, Safran up about 4%, BAE Systems 26%, Rolls-Royce 26%, and so on. So MTU Aero Engines up 8%. So I still think that's got further to run. Interestingly, today there was a news story, let's just flag it up here, about Europe deciding to go down the French route, which is to exclusively buy European for the rearmament. So let me pull that up. Here we go. So this is the story I was looking at today. The EU is going to exclude US, UK and Turkey from their 150 billion rearmament fund because France wanted to buy European. Okay, so basically they won the argument. So not good news for UK companies, certainly. But it says that at least 65% of the cost of the products would need to be spent in the EU, Norway and Ukraine. The remainder could be spent on products from third countries that have signed a security pact. So it's not exclusive, but it is almost exclusive, which is interesting. Yeah, so obviously the UK, not terribly happy about that, but not a total surprise, I have to say. Yeah, so I don't think it's too late, but I think there's kind of further to run with that trade. Okay, how are we doing? Any more questions? Franz Leinhardt says, Cocoa in bed. Ha, I've had my beer and I'm in bed, watching on the iPad. Good for you, Franz. Ah, brilliant. Yeah. No strings. Do you still hold the same fund you mentioned in previous videos, VHVG? Yeah, so my core, there's a story to come there, so I don't want to spoil the story. Members of our community have already seen this story, but I haven't published it on YouTube yet, so I can't tell you. It's a secret, but it affects my core holdings. I should tell you that. Oh yeah, interesting. A super chat from David Walsh. He says, what copper fund are you buying and how? Wisdom Tree has a few funds, but never sure which is best. Now what I've done is slightly different to buying a fund. So certainly Wisdom Tree has this fund, COPR, I think. Yeah, here we go, copper. A very good ticker for this one. So Wisdom Tree has this fund. Come on. So I'll accept everything. I like Wisdom Tree because they've got kind of slightly off the shelf, kind of non-pedestrian ETFs, slightly unusual ones. So if you want exposure for something which is a little bit non-vanilla, Wisdom Tree is usually the asset manager which comes up with it. So for example, they've got a kind of leverage 60-40 core portfolio. So if you want to do return stacking, you can do it with that fund. And copper, they've got this copper exposure fund as well. So yeah, so that's one choice. Let's just get the fact sheet for that because I just want to see the one that trades in sterling. Yeah, here we go. So you look for London Stock Exchange. Here we go. There are two funds. COPAR trades in dollars on the London Stock Exchange. COP-B trades in sterling. So that's the one I'd go for. And yeah, so that tracks the price of copper, presumably through the futures market. Yeah, gives a total return exposure to copper futures contracts. And presumably it does something clever with the roll costs, although I'm not able to work out what that is very quickly. Yeah. So it's copper futures. How do you optimize the roll cost? Yeah. Roll yield. Okay. Looks like they don't do anything to fix the roll yield, but yeah. So that's one fund. But look, this is what I've done. Slightly different, right? So have a look at my copper miners portfolio. So what I've done is these are the list of stocks that I thought would give me copper exposure. So this is Stockopedia, and they rank stocks according to its fundamental strengths. And there are three rankings they look at. They look at value, quality, and momentum. And if it scores well on all three, then the overall stock rank is high. So what I've done is I've weighted my portfolio fundamentally. So for example, First Quantum Materials would have a high weighting because it's got a high stock rank. Glencore, on the other hand, has an awful stock rank. So that one will have a lower weighting in my portfolio. So that's what I've tried to do. I've tried to fundamentally weight it so that the better companies have a bigger proportion in my portfolio. I've got to say it hasn't done particularly well. But look, the price of copper hasn't been particularly good either. So I'm not too bothered about that. And there's one I'm going to hold for a long period of time. They tend to pay high dividends, so, all good. And they're all fairly liquid stocks. The bid offer spread on all of these. Let me move my face so you can see it. The right-hand column here is the spread in basis points, the bid offer spread. Most of them are very liquid with just 1 basis point, 2 basis points bid offer spread. There are two tiddlers here, Euro Copper and Hudson Bay Minerals. Those two have fairly wide bid offer spreads, but on the whole very liquid and pretty large stocks. Those are. So copper, yeah, that's my copper portfolio. How are we doing? No String says, unfortunately I'm not in the community, but I think I can guess what you've done. Right. I work in the energy generation and the backlog for parts is years due to the transition to net zero and sustainable power. Interesting. Takes 10 years to open a new mine. That is shocking. Okay, and Gavin Lawrence says there's a 2 times leveraged copper fund from Wisdom Tree, LCOP. Interesting. I don't usually go for the leverage stuff very often. Okay, so I think we'll kind of draw a line under it there. If we haven't got any more super chats, yeah. So no more super chats. So let's draw a line under it there. We'll be back tomorrow. Tomorrow we're going to be on here at a much earlier time, thank goodness, of 6 o'clock for the live stream tomorrow. Same top, same me, but talking about the Bank of England, which will be interesting because I think they probably will hold this time, but they'll be talking about the effect of tariffs on the UK, which is very interesting. Anyway, look, thank you for joining us, and we will be here tomorrow, 6 o'clock. Please do like and subscribe, and hopefully we'll see you then.